How do you make sure you aren't one of the 73% of new crypto investors who lose money in their first year? The crypto market's looking good right now, right? You log in and everything is green. But here's the catch. You might still be making mistakes that are quietly holding you back from maximizing your gains. These are mistakes even experienced investors make, and some of them will surprise you. In this video, we're breaking down the top 5 crypto mistakes you are probably making right now and, more importantly, how you can fix them. The first mistake people make is trusting centralized exchanges too much. When you buy crypto, you're probably buying it from somewhere like Coinbase, Binance, or Kraken. So you log in, select your amount, and hit buy. Congratulations, you're now a crypto investor. Let's wait a few months, and then we'll buy that Lambo, right? Well, here's the catch. Many people leave their crypto sitting in their exchange account. In theory, this makes sense. It's convenient, you can trade quickly, you don't have to worry about transferring funds, and it feels like your money is safe. But here's the truth. When your crypto is on an exchange, you don't actually own it. It's like storing your money in someone else's wallet. And as the saying goes in crypto, not your keys, not your crypto. A perfect example of why this is a problem is FTX, one of the largest and most trusted exchanges at the time. In late 2022, FTX collapsed seemingly overnight. Billions of dollars in customer funds, money people thought was safely sitting in their accounts, were suddenly gone.
Explain away something very simple, which is that millions of or a million plus customers trusted him with their hard-earned money, and rather than honor that trust, he reached into it, lent it to an affiliated hedge fund, which made wild trades that would only profit him personally.
Why? Because FTX was mismanaging user assets behind the scenes. When the company filed for bankruptcy, customers learned the hard way that they weren't in control of their funds. Over 1 million customers were impacted, and many never got their money back. It was a harsh reminder that centralized exchanges are not bulletproof. Obviously, not every centralized exchange is going to end in catastrophic bankruptcy like FTX did. But there are still other risks. Hacks. Exchanges are massive targets for hackers because of the huge amounts of crypto stored on their platforms. Freezing withdrawals. During periods of volatility, exchanges can freeze withdrawals, locking you out of your funds when you need them most. When the charts are green like they are right now, your crypto balance could grow into a significant amount. So with that in mind, why take the risk? The best way to keep your crypto safe is by moving it into a hardware wallet like Ledger. Ledger gives you full control of your private keys, so you actually own your crypto. Plus, it keeps your funds safe offline, where hackers can't touch them. We have a link in the description where you can grab a Ledger hardware wallet. The main takeaway point here: if you are serious about protecting your investments, don't leave them on exchanges. If you're finding this helpful so far and want to stay ahead in crypto, make sure to hit that subscribe button. Here at Crypto Coast News, we are always sharing tips like this to help you keep your investments safe and make smarter moves in the crypto market. Now that you've moved your crypto off exchanges and into a secure wallet, you might think you're all set. But here's the thing, are you just letting it sit there? If part of your portfolio is in stablecoins, you could be missing out on an easy way to earn passive income. In traditional finance, banks pay you interest for depositing money because they use it to fund loans and investments. The same principle applies in crypto, but instead of banks, DeFi platforms let you earn yields on stablecoins like USDT, USDC, and DAI. Here's how. You can lend your stablecoins on platforms like Aave or Compound and earn interest. Stake them on DeFi platforms or exchanges for competitive rewards. Or provide liquidity to decentralized exchanges like Uniswap or Curve, earning trading fees. Let's say you're holding $5,000 in stablecoins. A yield of 5% could earn you $250 a year. And in bull markets, some platforms offer 10% or more, meaning your idle funds could work harder for you. Of course, there are risks, like depegging, where a stablecoin's value drops below $1. To mitigate this, diversify your holdings and focus on stablecoins with strong backing, like USDC. Also, use audited platforms like Aave or Compound to avoid security risks. Finally, stay informed about regulatory changes, as governments are increasingly scrutinizing stablecoins. With the right approach, stablecoins aren't just a safe haven. They can be a powerful tool for growing your portfolio. So now you've learned how to make your stablecoins work for you. But what about staying ahead of the market? Crypto is unique because it's completely transparent. Every transaction is recorded on the blockchain for anyone to see. Yet most investors completely overlook this treasure trove of data. That brings us to mistake number 3, ignoring on-chain metrics. Unlike traditional finance, where insider information is hidden, the blockchain makes everything visible. By using on-chain metrics, you can get insights that are impossible to find in traditional markets. Here's what you can track. Whale movements. If you notice large wallets, aka whales, moving coins to exchanges, it's often a signal they're planning to sell. Accumulation trends. When whales or smart money wallets are quietly buying, it's a strong sign of confidence in a project. Token flows. Watching tokens flow in and out of exchanges can tell you if selling pressure is increasing or decreasing. These insights give you early warnings of trends and significant events before the crowd notices. Let's go back to our FTX scenario from earlier. In the days leading up to its bankruptcy, on-chain metrics revealed massive withdrawals of FTT tokens, FTX's native cryptocurrency. Whales were quietly exiting, while the general public had no idea what was about to happen. Those who paid attention to these signals had a chance to act early, selling off risky assets or moving funds before the news broke. On-chain metrics can literally be the difference between protecting your portfolio or taking a huge loss. You might think this sounds complicated, but it's easier than you'd imagine. Tools like Nansen make tracking on-chain data incredibly simple and actionable. Here is how Nansen works. Let's say you want to look at the flows for a particular token. You can use the search bar or press Command K and type in the token code. This brings you to the Token God Mode page, where you'll see the price chart and price movement history. On the right, you'll find the wallet activity ordered by value. Here you can see that a user named Token Millionaire has bought $754,353 worth of ENA in the last 24 hours. What's even better, you can click on this trader to see their historical portfolio, token balances, and transaction history. You can even add their address to your watch list to track what they're doing in the future. Nansen gives you the tools to see what the biggest players are doing and make smarter decisions based on real data. Nansen isn't just about tracking whale activity. It's packed with features designed to help anyone interested in crypto trading or investing. Whether you're monitoring tokens, analyzing DeFi protocols, or researching new projects, Nansen makes on-chain data easy to understand and act on. They offer various plans depending on your needs, and I've included a link in the description so you can check it out for yourself. Now that you've seen how to use on-chain metrics to level up your strategy, let's talk about another common mistake: focusing only on the big-name cryptos. There's a whole world of hidden gems out there that many investors completely overlook, and this could be costing you some major opportunities. Think about it. Bitcoin, Ethereum, Solana, these are the stars of the show, and for good reason. They're established, widely recognized, and trusted by investors. But here's where the mistake comes in. Many people get stuck in the comfort zone of these big names and never explore the smaller, lesser-known projects that could be tomorrow's breakout stars. The truth is, the crypto market isn't just about the heavy hitters. It's packed with innovative projects flying under the radar. Projects that could completely change the game if they gain traction. Sure, Bitcoin might give you a solid 10-20% return in a good year, but with smaller projects, the potential is far greater. A well-researched token can deliver returns of 5x, 10x, or more, especially if it taps into an emerging trend. Take Toncoin, for example. It's the native cryptocurrency of the Ton, the open network blockchain, which focuses on high-speed transactions and scalability. Back in early 2024, Toncoin was relatively unknown, sitting with a market cap under $10 billion. As the platform gained traction, though, its value started climbing. Early investors who saw its potential didn't just make gains. They rode the wave of a project that's now on the radar of major players. But finding hidden gems isn't about throwing money at random small-cap tokens. It's about knowing where to look. Start by evaluating the use case. Does the project solve a real problem in the crypto space, or is it just hype? Next, check the community. An active and engaged following on platforms like Twitter or Discord often signals genuine interest and momentum. Finally, Tools like Nansen can help you take it a step further by identifying accumulation trends, showing you where smart money is quietly buying up tokens before the hype kicks in. Exploring smaller projects might seem risky, but it's where some of the biggest opportunities lie. It's about balancing the stability of big-name cryptos with the growth potential of hidden gems. After all, sometimes the best opportunities are the ones nobody else is looking at. If you're learning something new and finding value in these tips, don't forget to subscribe to the channel. We break down crypto concepts every week to help you make the most of your crypto and avoid costly mistakes. Let's keep going. Now that you've explored the potential in hidden gems, let's move to one last mistake that can quietly drain your profits. Failing to account for fees. This is an easy one to overlook, but can make a huge difference in your bottom line. Fees in crypto are like hidden taxes. They're small, often ignored, but they can add up quickly and eat into your gains if you're not careful. Whether you're trading, swapping tokens, or withdrawing funds, every transaction comes with some type of fee. Let's take Ethereum as an example. When the network is busy, gas fees can skyrocket. You might pay $50 or more just to make a single transaction. If you're making frequent trades or swapping small amounts, these fees can quickly stack up and wipe out your profits. And it's not just Ethereum. Centralized exchanges charge fees for every trade, typically around 0.1% to 0.5%, which doesn't sound like much until you start trading regularly. Over time, these fees can quietly erode a significant chunk of your portfolio. The good news is, you can manage these costs with a bit of planning. Start by choosing platforms and networks that are known for lower fees. For example, Layer 2 solutions like Arbitrum or Optimism drastically reduce transaction costs compared to Ethereum's mainnet. Similarly, decentralized exchanges like PancakeSwap on Binance Smart Chain are far cheaper than those on Ethereum. If you're using centralized exchanges, take a look at their fee structures and consider consolidating your trades instead of making frequent small transactions. Some exchanges even offer fee discounts for holding their native tokens like Binance's BNB or KuCoin's KCS. Finally, make sure you're keeping track of these costs. Many portfolio tracking apps can give you a breakdown of how much you're spending on fees so you can adjust your strategy if needed. Ignoring fees might not seem like a big deal on a single transaction, but over time, they can add up and make the difference between a profitable portfolio and one that's just breaking even. By understanding and managing your fees, you'll keep more of your hard-earned gains in your wallet, where they belong. We've covered a lot today. Trusting centralized exchanges, missing out on stablecoin yields, ignoring on-chain metrics, overlooking hidden gems, and now failing to account for fees. These are mistakes that even experienced investors make, but with a little knowledge and planning, you can avoid them. If you found this video helpful, make sure to subscribe for more crypto tips and strategies. And if you're ready to secure your crypto and level up your research, check out the links in the description for tools like Ledger and Nansen. Thanks for watching, and I'll see you in the next video.